Hello investors. So I've gotten a lot of requests to do a video on these two Roundhill investment funds. I had to do a double take. I thought at first they were saying they wanted a roundhouse kick me. A lot of people say that in the comments, but they were actually asking me to cover these two investments by Roundhill investments. So they are called XDTE and the other one is called QDTE. So we're going to cover both of them because essentially the strategy is the same. They're just tracking different indexes. QDTE is tracking the Nasdaq 100 and then XDTE is tracking the S&P 500 index. Other than that, other than whatever index they're tracking, the strategy is going to be the same. So let's read a little bit more about what this fund does. Strategy here is that XDTE utilizes a synthetic covered call strategy that seeks to provide current income on a weekly basis while also providing exposure to the price return of the S&P 500. So one key thing there is that they're actually giving us income on a weekly basis. So many of these income ETFs, they give out monthly distributions, which is awesome, right? Like if you're in retirement and you're getting consistent monthly income, that could really help, pay the bills. That's very useful. And a lot of just regular equities that many investors own, if they pay dividends, those typically only come out on a quarterly basis. So here's a chance to get weekly payments, and weekly payments help cash flow. And, it's just great to get that money compound a little bit quicker. So that's one key difference here. They're also doing synthetic covered calls, so it's a little bit different than actually owning the underlying index or any of those equities that make up the index. So the Roundhill S&P 500 0 DTE covered call strategy is the first ETF to utilize 0 days till expiration options on the S&P 500. So XDTE, it's getting overnight exposure to the S&P 500, and that allows it to generate income each morning by selling out of the money 0 days till expiration calls on the index. This is going to be an actively managed ETF, so don't expect anything passive here, and that's going to be reflected in the expense ratio, which we'll get to soon enough. You can see some of the potential here, guys. They're doing very quick options plays. This is kind of like a poor man's covered call. So let's just kind of quickly go over what that is. So this is a poor man's covered call is an options trading strategy that mimics, which is very similar to the synthetic word that we're using here, the profit potential of a traditional covered call strategy, but with reduced upfront capital requirements. So you don't need the full 100 shares amount to do this strategy. That's why they call it a poor man's covered call. And here's how it typically works. So there's a long call option. So instead of buying the underlying equity, and I can show this here in this presentation that they have. So we're getting a long call option. So instead of buying the underlying stock directly, the trader will buy a longer term call option on the stock that they are interested in. And then this call option should have a strike price that is close to or slightly in the money. And then at the same time, simultaneously, the trader is also doing a short call option. So the trader is going to sell a shorter term call option on the same stock with the same or higher strike price than the long call option. Now this short call option is usually out of the money. So guys, let's look at what they gave here in this visual presentation. So each trading day, the fund will sell a covered call against its position on the index, seeking to generate options income. Now, daily returns, they're going to be capped at the sold strike, right? So we have the covered call position is this thicker line purple, and then the long position is going to be this dashed one, right? So by the time that the stock market ends trading for the day, they only have that long exposure, and that's why they're going to be having full exposure to the index during the overnight session. So let's get into some more reasons on why people might want to invest in QDTE and XDTE. So it's a way to harness volatility, right? So you're getting 0-day options on the Nasdaq 100. It's a way to potentially exploit structural market mispricing. It's a way to get high income potential. So by doing these option plays, we're getting very high income through the covered call strategy on the index. And then of course there's those weekly distributions. You're getting weekly distributions on those sold option premiums, those juicy dividends. And we can see here, guys, if we go to XDTE's dividend history, this is pretty unique. It's very unique to see a weekly payment. And this fund has only been out for a short amount of time, been out since March. They've been giving out weekly dividends. Again, it's very nice to get this income, help pay for our living expenses, help us in retirement, help us compound and cash flow a little bit faster. But at the same time, guys, we are going to be paying a little bit higher of an expense ratio. So you can see it's 95 basis points. That's not super cheap. It is actively managed. This is a pretty small fund provider from what I can tell. They only have $27 million in assets under management. So just keep that in mind, guys. You guys are probably wondering, okay, what about that dreaded word that I always talk about in these videos? What about NAV erosion? So for XDTE, it's really not happened here, right? So they've been around since March 7th. They were trading at 52.46 to open. You can see in their, what is it now, 4 months that they've been out, it's still 52.29, and they've been getting weekly dividends. And, you know, if you're getting weekly dividends, so XDTE is giving out a 26% yield. It's on pace to give out a 26% yield. QDTE is on pace to give out a 40% yield. Those are both very impressive numbers, super juicy. Of course, it's going to come at a cost, right, if there's NAV erosion, but so far that has not happened. And we can see the same thing for QDTE. I'm not sure why one was in night mode, but not the other. Anyway, so you can see over their lifespan, right, it opened on March 8th at $45.58. About 4 months later, it's still pretty impressive, down a little bit, about 3% at 44.18. So NAV erosion hasn't really happened yet for these two zero-day options trading ETFs, but that doesn't necessarily mean that it won't ever happen, right? There is something that I want to show you guys. So if we go and take a little snippet of the VIX, so the VIX is something that investors look at to represent expectations for volatility over the coming 30 days. So if you see kind of these big spikes in the VIX, that's usually when there was a little bit more volatility in the market. Different market conditions, different economic factors, news, right? Those all impact how much volatility there is. And you can't really predict that kind of stuff. It just kind of happens, right? But this is what investors are using to kind of gauge where investor sentiment might be. So I just want to show you guys something. So you'll see kind of the last time that the VIX spiked was in April. So we can see right there on April 15th, it spiked from 14 to 19 in basically a few days. Now, if we look at QDTE, for example, you can see around that April 15th time, that's when this fund really lost a lot of value basically in a short amount of time, right? They lost over 5%. Now, the important thing is that they were able to recover, and they've done pretty well since then. You can see the same thing on the XDTE. Around that April 15th time period, you can see that the fund just kept going down and down. That's when volatility was pretty high for that short period from April 15th kind of all the way to April or May 1st. It kind of ended there, and we've kind of had pretty low volatility. And then of course, this past week, there was a lot of, political news, potential tariffs depending on who wins the presidency in November. So that we saw an increase in volatility as well in the VIX. So if we go back to how QDT has just performed in the last 5 days, you can kind of see some of that NAV eroding again there as well. So that's what my major concern is here, guys. Again, trust me, I'm with you guys. If there was a chance to get a 26% and a 40% yield with no risks, sign me up. Like I definitely take that in a heartbeat, right? Those are very impressive returns. But keep in mind the average S&P 500 return over long periods of time is 7 to 10%, and it's that percentage for a reason, right? If people could get substantially more than that, almost 4 times that with no risk, they would gladly do that. But that is the risk here, guys. If the VIX has a lot of volatility, kind of, you can see here, right, during C19, look how quickly it shot up, right? There are going to be outliers, right? Especially over long periods of time, your chances of having one of these extreme spikes is just going to get increased and increased, right? We had this during the 2008, 2009 financial crisis. We saw this again during C19. So if you have a gigantic spike like this, it could really wipe out potentially all of your gains from years of investing in QDTE and XDTE. Now, of course, there's always a chance that you might get your dividends back and, you know, eventually you'll be able to pay off your initial investment. That's, of course, then you're maybe playing a little bit with house money. So some other things to keep in mind about these funds, right? They have a pretty nice FAQ section down here. Whoop, don't want that. Don't want to stay up to date. So the FAQ, when did it launch? It launched in March. What are the fees for these ETFs? 95 basis points. So that's going to be $95 for every $10,000 that you guys have invested. Can you trade options on the 0-day options? ETFs, yes, it is available. That's essentially if you want to do basically options trading within options trading, if you own 100 shares of these. And then it is actively managed, guys. So keep in mind, there is a fund manager that does all these trades every single trading session. And that's, again, why the expense ratio is a little bit higher than you would normally expect. And then how do they generate income? Well, they're generating income daily by selling 0 days till expiration call options. And that's what allows for those weekly distributions to shareholders. So what type of options does this fund use? So they're actually using the European style flex options. So if you're not exactly sure what that is, essentially these are non-standard options that allow for kind of special negotiations. They're essentially what big investors like hedge funds or institutions, they kind of use these flex options to customize their contracts more than just regular options would. This means they can choose things like when the option expires, how much the price needs to change before they can buy or sell, and other details. Now, these are typically not available for smaller investors. They typically have specific rules to make sure that they're used properly by big traders on major exchanges like the SIBO. So that's kind of what flex options are, guys. Goes into detail about what a covered call strategy is. I think, at this point I've made tons of videos explaining what that is. And then 0-day options, guys, that means that it's they're set to expire on the same day which they are traded. So very short, quick turnaround. And then it goes over the benefits of selling options at the market open. That it potentially allows for investors to capture the full return of the overnight session. That's what we kind of saw in this visual that I was showing earlier here. That's what we kind of see here. Unlike other strategies, it holds a short option position overnight, and it's uncapped from market close until a new short call position is entered in for the following session. So again, guys, I'm kind of just summarizing what's available here for you guys. Let's read this Investopedia article together, guys. This is written by Daniel Liberato, not by me. It's fact-checked by Vicky Velasquez. It's interesting that they put a fact checker in there. So 0 days till expiration. These are an option contract this is essentially an options contract that is going to expire within a day. So it even mentions in this article that 0-day options have entered the mainstream investing market in recent years. So that's why we're seeing some of these ETFs now come out, right? These may have been options trading strategies that a lot of rich people, a lot of like hedge funds, investors, they may have always been practicing this strategy, but now it's becoming a little bit more mainstream so that the average retail investor can get in as well. So some key takeaways that they are essentially a way to make a quick buck. We're going to talk a little bit about why this might be similar to gambling rather than actual investing here. The window is pretty small, the trading window. The buyer is plotting needs that need to happen fast. And then the play is to sell options on the last day that they are valid, and that maximizes that premium decay. What's really nice is that since it is actively managed, we have somebody that already has the expertise, the knowledge, hopefully, to execute these trades on our behalf. And, in exchange for that expense ratio, we get some of those dividends every single week. So an options contract it gives the buyer the right, but not the obligation to buy or sell an underlying asset at a specific price within a specified period. And then it's also going to come with an expiration date. And then if the option isn't fully executed by then, if it doesn't reach that strike price, then it just becomes no longer valid. It expires completely useless. So that's kind of what they're trying to harvest here, guys, because by getting to 0 days expiration, they're essentially at the last day to make that option usable. All right, guys, so is this options trading strategy profitable? It can be extremely lucrative, or it could be costly as well. Did you really think I was only going to go over the pros? The stakes that happen in any given day in the stock market, they're huge, right? I've seen huge stock market rallies. I've also seen huge stock market corrections happen in a very short amount of time. The author goes on to say that numerous stories have surfaced of people getting burnt by 0 days till expiration options, and they're basically the equivalent of a lottery trade. Now, I want to emphasize, guys, I did not write this article. Daniel Liberto did, so don't blame me if you're unhappy with what it's saying. So again, guys, there is going to be potential for risk here, right? You're not going to get a nice 26 to 40% yield without taking on some kind of risk. I'm not saying that you can't make money from these types of funds. I definitely see the allure. I think, for somebody that maybe has a little bit higher of a risk tolerance, I could see why some people want to be invested in these. Just know there are going to be risks, especially if the VIX spikes, if there is a lot of volatility in a very quick amount of time. These investors potentially could lose a lot of money. One thing I also wanted to cover was the distributions on a weekly basis. So it says here that these distributions may exceed the fund's income and gains for the fund's taxable year. So distributions that are in excess of the fund's current earnings and profits, they're actually going to be given to the investor as a return of capital distribution. Now, ROC, or return of capital, that's not inherently bad. It's only bad if the fund is just not making enough money, and then they're just giving away their own initial investment, right? So that's why NAV erosion is definitely a real thing. It's not a myth no longer, no matter how many YouTubers say it. Thankfully, we haven't really seen much NAV erosion happen with this fund. So that means whatever they're making in their trading strategy, for the most part, they're able to actually cover and give out real distributions. They're not just giving you back your own money necessarily. Let's also just kind of quickly see how these funds have done to the overall market. So if I compare this to the S&P 500 since the time period that these funds have been out, we can see here that XDTE compared to SPY, it's actually just slightly trailed the overall market, 18.43% to 22.22%. Again, that's not necessarily a bad thing. And people that typically invest in these are not necessarily trying to beat the market. They're just trying to get some nice monthly, or in this case, weekly cash flow. So guys, let me know what you think about XDTE and QDTE in the comments below. Now, there is one company that I think is going to blow both of these ETFs out of the ballpark, so be sure to check this video out right here. Guys, my videos are always found in podcast form under the Collect Cash podcast name. Be sure to join the Patreon, get full access to my full $200,000 portfolio, and I will catch you on the next one.